So, Peter, Happy New Year to you, buddy.
Yeah, you guys too. Thanks.
You're one of my favorite guests to interview. Are you going to be showing something or?
No,
Uh,
I'm just going to be speaking.
okay, then let me share
So,
my screen.
Peter, I see you're a fan of Train Simulator.
Uh, that's my son.
That's your son. Okay, nice.
He likes to play with my laptop, so that's his.
Okay, no problem. Would be nothing wrong with you doing a little bit of playing on the side. Everybody needs some R&R, right?
Yep.
Okay, Peter. So I'm going to be showing the screen. In fact, I'm going to be showing your website here, the book report.
Okay.
And Happy New Year. I hope this is a great year for you. What
Yeah,
I
you as
see some
well.
of the things you're writing about. What are the major themes and narratives that you're drilled down on going into 2020?
Well, I think there are a couple of really big things that need to come to fruition. I would define the 2019 equity rally as a hope rally, a hope that the Fed would be able to engineer a soft landing, a hope that a China trade deal would lead to an inflection higher in economic growth after the softness in trade, manufacturing, and capital spending, and of course, certainly helped out by the expansion in the Fed's balance sheet. So, in terms of catalyst in 2020, well, we're not going to get a phase two this year,
Okay.
highly
Why?
unlikely. So,
Oh,
well, I
because
think
phase one's a major accomplishment going into the election. They don't want to give them any more.
I think that the Chinese have given us all that they are willing to give. And
Okay.
even Trump the other day said that he wouldn't expect the phase two until after the election anyway. And I think either way, we're still left with almost all the tariffs that were implemented last year. So here we are with, yeah, phase one, but stuck with all the tariffs. And the tariffs are on goods totaling about $360 billion. So I believe that trade deal catalyst has been exhausted. The Fed is not going to be cutting rates this year, I don't believe. But if they do, it's because growth took a leg downwards, which is not something that people should be rooting for. And I do actually think that rather than continuing to expand their balance sheet through the second quarter of this year, I think there are light bulbs going off in the Fed that what this expansion of the balance sheet has created is another asset bubble and another expansion in valuations that's disconnected from underlying business fundamentals. So Robert Kaplan, the Dallas Fed president, who this year is a voting member, was the first one to echo that last week when he did acknowledge the rise in asset prices that's coinciding with the expansion of the Fed's balance sheet. Now, I know the Fed didn't intend that to happen because they did that to quell the earthquake in the repo market back in September.
Right.
But things don't happen in a vacuum, and at least there's one Fed member that's acknowledging the connection between the Fed's balance sheet and the value of credit and stock prices.
Okay, so that was an earthquake, and sometimes, Peter, earthquakes are followed by aftershocks, and they're trying to quell the aftershocks. Is there uh, another seismic event that's going to happen in the repo overnight Fed funds market, and is it really the canary in the coal mine for something systemic?
Well, I think the market now, that overnight market, is becoming addicted to what the Fed has done. And the Fed, their answer to every problem is just throw money at it.
Right.
And yes, it's had a temporary quelling effect on that market, but when they start to extract themselves from it, that'll be the real test on whether this market can walk on its own again. Now, there were regulatory constraints that led to that. So I don't know why they felt that just throwing money at the problem would deal with a regulatory issue. So when the Fed tries to walk away, we'll see how that market can handle it. When the Fed stops expanding their balance sheet, we'll see where credit spreads and stock prices go. And the last thing to wrap this up in terms of what I'm looking for is earnings need to accelerate. Earnings growth,
Right.
or there was no earnings growth. Earnings decelerated in 2019 with a
Right.
modest decline. So you had about a 4 to 5% revenue increase to S&P top line, but that was more than offset by a decline in profit margins. And I think that profit margin story is going to continue in 2020, mostly because of a rise in labor costs. So the math that the street has that earnings are going to go up around 8 to 10% this year, I just don't understand the math, because that assumes that profit margins out of nowhere start to re-accelerate. And I don't see that, because if the economy gets better, wage pressures will continue to grow, and that would offset any revenue increase. And if you are a company and you see profit margins that are getting squeezed, well, you're not just going to sit there. You are either going to slow the pace of hiring, you're going to reduce the hours that your employees are getting or are working, even though they're getting paid on a per hourly basis more. You may slow down capital spending. You may slow down your stock buybacks. So I think that's going to be an important story in 2020, just as it was in 2019. But of course, it was ignored in 2019 because we got multiple expansion instead for the reasons that I stated.
Yeah, I mean, it was a Fed year when we had the three Fed officials, two former, singing Kumbaya in January. So I have to ask you, with everything you've mentioned, how do yields come into play with what's going on here? We're kind of trapped in a range in the 10-year between, I would say, about 175 and 2. Which way do you see them coming out? Do you see them coming out one more decline in yields in the 10-year, or have yields already bottomed in your view?
Well, it gets me to one thing that we've spoken about in the past, and what I think is potentially another big story of 2020, is where do European bond yields go? Because where European bond yields go, I think that's where U.S. yields will go. And even today, the German 10-year bond yield quietly is at the highest level, or the least negative, since May, at minus 18 basis points. Last August, that yield was minus 70 basis points. So if you see a continued rise in European bond yields, you will see, I believe, a continued rise in U.S. interest rates. I think there's a lot of pressure on the European Central Bank to begin the process of getting out of this negative interest rate regime. We saw it in Sweden at the end of last year, the Riksbank finally deciding that negative interest rates was just a bad policy. And if you do see that in Europe, I think that is the potential tinder for, speaking of earthquakes, an earthquake in the global bond market. Because when you take a step back, it's where the bond yields and bond prices are where the major excesses are in this cycle. And with obviously negative interest rates being the epitome of a bubble. So if you start to see them and even the Bank of Japan starting to walk that back, I think that can have major implications for U.S. rates. And speaking of Japan, they may not necessarily walk away from negative rates on the short end, but Kuroda has told us that he wants higher interest rates on the long end. So just imagine, 25 plus years of yield suppression in Japan, and now all of a sudden they say they want higher long-term interest rates. I think that's a really big deal.
Okay, so with the scenario you've just painted, it sounds like one of the pillars for euro weakness, dollar strength has been eliminated. Mark Chandler talked about this, and I know you were not a dollar fan for quite some time, and all we've done is move sideways. Could we finally be embarking on a dollar top and a weaker dollar regime? And isn't that the easiest thing to be sacrificed at this point in the economic cycle, that a lot of people won't notice a weaker dollar, but it could help us, at least in nominal terms, asset prices?
Well, I think it's a mixed bag. Who's been the major buyer? Who's been one of the major buyers of U.S. corporate credit over the past couple of years? It's been foreign buyers. It's been the Europeans. It's been the Japanese, all desperate for yield.
Okay.
So all of a sudden, the euro starts to strengthen. If the yen starts to strengthen, if the British pound starts to strengthen, well, what does that mean to these fund flows into corporate credit? You take even the Japanese specifically. There's a sovereign wealth fund there, essentially, a big pension fund that's been a massive buyer of U.S. CLOs. Well, all you need is a modest rise in the yen, and all of a sudden you wiped out a year of coupons. So I would not be rooting for a weaker dollar, thinking that that's going to be the be-all, end-all. Also, that could lead to higher inflation. That can lead to higher U.S. interest rates. So any specious benefit it does give to U.S. multinationals in terms of earnings, I think could be offset by those factors that I stated. So I'm not a believer that that's necessarily going to be good for us, especially when you have corporate credit spreads as tight as they are, and all you need is a reason for those flows, those strong flows, to slow down.
Okay, so yeah, a weaker dollar would actually create some risk off, in other words. Is that
I
what you're
think
saying?
potentially. Now, I think it would be good for emerging markets. It would be good
Right.
for those foreign companies and countries that have dollar-denominated debt and paying it back.
Right.
I'm more of a fan of a stable dollar, not a strong one, not a weaker one. But I think there's this belief that, okay, weaker dollar is just good for everybody. And I'll argue maybe it's good for some, but it's not necessarily good for others. I mean, we have U.S. interest rates that we need to keep low in order to keep this whole thing going, essentially. And the worst thing that can happen is higher inflation, which ties the hands of the Fed and would lead to higher interest rates. And if you got a weaker dollar of substance, that could lead to higher U.S. inflation. We have services inflation that's already sticky, running at around 3%. So if all of a sudden you tie that with goods inflation that rose because of a weaker dollar, then you may have a more of a difficult situation in terms of interest rates.
Okay, and the yield steepening that's occurred over the last couple months, just a correction of the rubber band snapping back a little bit, or could this be an ongoing or beginning of a secular trend because we inverted and now we're beginning to steepen?
Well, obviously, the Fed cutting 3 times certainly helped that yield curve steepening.
That was
And
their
then you
goal?
right, and then you combine that with the rise in European and Japanese bond yields, helping to lift U.S. yields, and then you also have, this hope for a reacceleration of growth, and then you have this. But, the last couple of times we had the yield curve inversion that then went to a steepening. Well, that was just on the cusp of a recession because we were steepening more so because the Fed was cutting interest rates rather than steepening because U.S. growth would be accelerated.
Okay, and I want to acknowledge that, we've been talking for a few years now, Peter, and you're definitely a proponent and bullish precious metals as one of the better places to be. We've had a tremendous run, all in gear, or could this be also close to running its course, or are we just in the beginning innings?
I think we're just in the beginning. I mean, even at 1550 in gold, you're still about 30% below, actually about 20% below where you were in September 2011. Silver,
Right.
call it around 17, 18. It was near $50 in 2011. So I think this is just getting going. And I think that the correlation has been pretty tight between real yields, particularly the real 5-year yield, and the price of gold. And if you do, as I said, get a bump up in inflation, well, the Fed is not going to be raising interest rates anytime soon. So I expect real yields to get even deeper negative, which would be a big help to gold and silver. And then if we do get that dollar weakness from here, that certainly would be a big lift. I would caution people, though, geopolitics has a tendency to lift gold temporarily, but I would do not use geopolitics as a reason to buy gold and silver. Focus it more on where the dollar goes and where real rates go.
Okay, do you want to talk a little bit about the commercial and industrial loans? I'm showing your website that they're still going the wrong way, and this is kind of flies in the face of people who think that we're starting to bottom out with PMI numbers and we're going to turn. What's your point? The chart is obvious. You're looking for continued weakness here?
Well, it's a good statistic because it's a high frequency one. It comes out every week at the end of the week. And this is for the weekend of January 1st. And really just measuring the quantity of loans outstanding. In this particular case, commercial industrial loans outstanding. The charts for commercial real estate loans outstanding or credit card loans outstanding. So here we had the Fed, which cut interest rates 3 times last year on the hopes that corporations would borrow up even more. But corporations have been borrowing up on it in a binge for many years now in this expansion. So just because they cut interest rates doesn't really matter when interest rates are low anyway. So I think this shows this pushing on a string type response to the Fed cutting interest rates. Then, of course, you had the fourth quarter so-called trade deal, where the hope was, well, that would kickstart executive confidence on the CEO and CFO level to start expanding again. Well, looking at this chart, that doesn't seem to have been the case. So luckily, we do have earnings from a bunch of banks this week, certainly the large money centers and some of the big regionals. So hopefully they can give some color on why we've seen this sharp drop-off in C&I loans outstanding, which is at the lowest level since March, and it's not something you'd think we'd see based, again, on the heels of those rate cuts and on the heels of a trade deal.
Okay, and as well, going all the way back to President Trump's tax cut and easy Fed policy, it seems to me, tell me if I'm wrong here, Peter, that any of the gains of liquidity that corporations got from either the tax cut or easier money has really been gone, seems to me to have gone into financial engineering. Is that the way your work points to, that a lot of it has been for buybacks and dividends and really not a lot of hiring, no new plants and equipment, that really all of this money has just gone in to fuel the euphoric market that we have?
Well, that's certainly been, particularly with the repatriation. Now, I think it was very important to cut the corporate income tax rate in order to make U.S. companies more competitive with those overseas. But that's a long-term competitive situation that plays out over time. It really is intended to affect the location decision of a company when they're looking to expand a facility or a plant or build something from scratch. So I don't look at that necessarily as stimulative, but in terms of the immediate cash benefit, the immediate repatriation benefit in lowering that rate, yeah, that mostly went into the things that you mentioned and less so capital spending. But I'm hoping over time that cut would help the competitive positioning of multinationals in the U.S.
Okay, so I normally don't ask you about it, but you're writing about it. So technically, one of the worst givebacks in the market last week, even though indexes came off a little bit and gold and silver came way off their early week highs on the retaliatory strike, but they still closed higher on the week, whereas WTI put in one of the most negative candles I've seen in a while. Is there something else going on in oil that may not be as sensitive to, say, for example, what's happening in gold and other inflation hedges?
Well, I think it's a couple of things. I think people realize that the Middle East and OPEC is just not as relevant as it used to be. That the U.S. pumping 12 million-ish barrels per day is a new paradigm, and therefore mutes Middle East type disruptions. And even with the spat with Iran, it did nothing to impact the flow of oil. So I think that's a reason. Then, of course, you throw in concerns about the demand side because of slowing U.S. growth. I mean, the World Bank last week put out their 2020 global GDP estimate, and it's only 2.5%. Well, that's a pretty punk rate of growth, which means that the demand for oil will likely be somewhat muted. And the supply side, I think, is also somewhat muted, particularly in the U.S. with this falling rig count. But I think what we've seen with not just what happened with Iran, but prior to that, the bombing of the Saudi Arabian installation that had a 1 or 2 day effect, and that was it. So I think oil, or the price of it and its sensitivity to the Middle East, is certainly not what it used to be, and will never be what it used to be.
Well, the oil shares are cheap. They finally started to participate a little bit. Is that still a sector to avoid?
I mean, it is cheap, so I'm usually attracted to cheap things.
Yeah, that's why I asked.
Yeah, so it's. I think if you're looking for some dividend payers, certainly this area is one of those, whether it's Royal Dutch or Slav or whatever. But in terms of getting a sustainable move, I mean, I think you need oil above $75 on a sustainable basis in order to get a real move in energy stocks. Interestingly enough, though, in 2019, the stocks were so bad, but oil still rose about 30%.
Right.
You have the stock market that was up about 30%, where earnings actually declined. So somewhat of a paradox. But yeah, I think oil is a bombed out group. So it's probably a place to be. I'm just not sure what kind of bounce we'll get or when it will occur.
So, Peter, are you on the same page as a lot of guys that are talking about that the next big bubble is in the corporate bond market rather than in sovereigns and other debt instruments? And if so, I've been trying to do a little research. Is there any way or any instrument that you can look at and consider to take advantage of a problem in the corporate bond market?
Well, it's corporate and it's certainly sovereign. I mean, a negative yielding sovereign bond overseas, is a poster boy for expensive and
Okay.
floppy. And certainly the corporate credit names are certainly an outgrowth of that. I think on the sovereign side, I think an easy short is the Vanguard International Bond ETF, BNDX, Boy Nancy David X-ray, as it includes a lot of negative yielding bonds. So here you have this U.S. U.S. mutual fund that is one of the buyers of this negative yielding paper, which is interesting that you probably have a lot of 401ks in the U.S. buying bonds that will cost you money. And then, of course, you have the high yield and the investment grade indices that are very expensive, particularly investment grade, where its spread to treasuries is extraordinarily tight, and a high yield bond is only yielding you 5%. So certainly there's a lot of froth there. And I think if you get another year of declining earnings, which then crimps cash flows, I think there'll be a more discriminating eye on corporate credit, especially since the Fed is not going to be your friend in 2020 like it was in 2019.
Okay, and that's a very important theme. I can't let you go without asking you if you think that domestic politics with an upcoming election are going to play a big role this year. A lot of fear about someone like a Warren or a Bernie Sanders winning over Donald Trump in November. Your take on what's happening politically and any impact it could have for financial markets?
Well, I think everyone knows it's the obvious what happens if Bernie or Elizabeth Warren win. I think there's zero chance that Bernie wins and only a slight chance that Warren would win. I don't think that either will get the nomination, though it remains to be seen. So if it is a Biden or somebody more center, then that will be more of a horse race against Trump. I think a big question, though, is when you look past the presidential election is what happens with the Senate, because even if a Democrat wins and the Republicans keep the Senate and it's more of a split Congress, that would mitigate some of the effect of a change at the top. I think the markets won't necessarily start to respond until we get well into the primaries and there is some sense of who's going to make it on the Democratic side.
Okay.
But as long as I think the economy, if it holds up this year, if the markets hold up, then Trump will be tough to beat. But if, on the other hand, they lose control of the markets and the economy takes a leg lower because we're stuck with the tariffs or earnings decline or whatever, then it's going to be more of a coin toss come November. Again, assuming that Warren and Sanders don't become the nominee, because I think either have no chance to win.
Well, I'm a very emotional person, Peter. And if I was Jay Paul, after the way I've been treated by this administration, I would hike rates a couple times before the election.
Well, I think...
Just because, he hurt my feelings.
Yeah, well, you can imagine the tweet storm if that were to occur.
Yes, I can, yeah.
I think he'd feel like he needs good reason.
Yeah,
and I don't think he'll get that good reason because I don't see growth reaccelerating here. I mean, I think at best we're going to be stuck in this 2% range, and the Fed thinks that a 1.5 to 1 3/4 Fed funds rate should be correlated to or it should be the right policy for a 2% type growth rate. I disagree. I think rates are too low. But I think that
maybe just staying on hold would be enough for him. Let me ask you this, and I've had this question before. Talked to other people about the fact that interest rates, the way they're moving, Is it possible that there's going to be one more advance in the bond market? If you look at the chart, where you could have one more run to the upside in the bond market, and is that really your preferred short over the stock market in 2020?
That's a good question. I really think that the August rally last year in bonds and declining yields, that was right after Trump tweeted about the tariffs on all the remaining Chinese imports. I think that was the last blow off in bond yields. I'm sorry, in bond prices and decline in bond yields, because that was sort of the retest of the summer of 2016 when yields plummeted upon the Brexit vote. So while bond yields may have their declines and rally in bond prices if growth continues to weaken in 2020, but I really think that we're going to get a continued rise in European bond yields, which could be the drag higher in U.S. rates, even if U.S. growth remains punk in 2020. Then also you have all this Treasury supply, which has already impacted the short end of the market and really triggered this repo implosion. It was the first time in, everyone's been debating for 30 years, when is all this Treasury supply going to mean an upward pressure on U.S. interest rates? And of course, for 30 years, it never mattered. But now all of a sudden, at least on the short end, all this Treasury supply began to matter. And I actually think that it's going to begin to matter on the long end as well.
Peter, thanks a lot for coming in here and sharing your views looking ahead, and thanks for getting a microphone.
Yes.
And I hope this is a great year, people, if you're interested. And I really think that it's an important part of intelligence gathering to get Peter's views. He has a lot of free content. You could go to www.bookreport.com, spelled BOOCK report.com, and also follow Peter on Twitter at Boockvar. So great hunting to you this year, Peter, and maybe we could get back together in the spring, see what's manifesting, buddy.
Thanks so much.
All right, you're welcome. Everyone, that's Peter Boockvar. That's a wrap. See everyone for Turnaround Tuesday tomorrow. And don't forget also our promo. And I'll see everyone tomorrow. Don't just count your pips, count your blessings. Adios. Thank you, Peter.
Thank you.